Well, I think Stephanie made a good point. I think the U.S. economy is strong enough to handle higher rates. We are growing at 3% this year. I think the key, though, is that we've seen such a significant backup right now that it's going to be difficult to go materially higher from here unless inflation breaks out of this 2.5% range. The market is essentially priced for 3 to 4 rate hikes by the end of next year. I think the global economy is slowing, financial conditions are tightening, and importantly, we are seeing, I think, peak growth in terms of not only the economy, but also in terms of earnings. So I think the stock market is going to face a lot more headwinds going forward. Companies are going to face higher costs. These higher rates are hitting cyclicals like autos, housing, et cetera. So I think we're basically at peak now, and what that means is that rates could move a little higher, but most of this backup is over in our opinion.
But you think we could get to 350 though on the 10-year, right? Is that right?
It's possible. I think a lot of this is going to depend on who wins the midterms. If the Democrats win both the House and the Senate and you see an infrastructure package, or in contrast, if the Republicans are maintained both sets of the House and you try to get another tax package, that's possible just because of the deficit spending, so the pure technicals in the marketplace. But absent that, if you get a mixed House, I think most of this backup is pretty much over in terms of 10-year rates.
You sound somewhat concerned about the state of the economy, that maybe we've peaked, that we are at a tipping point, that companies like PPG, which gave that profit warning today, talked about higher input costs, lower demand, maybe just the start of something?
Well, the U.S. has been, as you know, Scott, decoupling from the rest of the world, and you've seen dollar strength. That dollar strength is going to be a headwind to earnings. Companies are finding it much more difficult to find labor. Those are going to be higher cost pressures, which will hit margins, and the rate effect is just starting to really hit these companies. The leading indicators are really these cyclicals like autos and housing, and there you're seeing the preliminary warning signs. Housing is going to slow at these rate levels. Granted, prices can still go up, but it's going to become less affordable to buy that house, and I think that ultimately is what's going to slow the economy.
The other issue is that for the first time in what feels like forever, you have some competition for stocks, don't you?
Yes, and the point is that bonds are as exciting relative to stocks as they've been in 10 years. High-quality bond funds are now yielding 5 to 5.5%. Granted, stocks have been the place to be for the last 10 years, but with earnings growth set to slow, the likely return on equities going forward is really going to be more of a mid-single digit. So bonds on a risk-adjusted basis here actually look quite attractive.